To Jim Rickards to get a read on this. Jim is the best-selling financial author who has a new book out that's called The Road to Ruin, the global elite's secret plan for the next financial crisis. Given the pause in the dollar's run-up, I first asked Jim whether the dollar bull run was showing signs of fatigue. Take a look at what he had to say.
Not necessarily, Amira. It's like with any momentum trade, it goes so far and then it'll take a breather. It could back off a little bit. But the basic trend has to do with the Fed increasing interest rates. It's really more at the short end. You're right. The long end yields have gone up and prices have gone down quite a bit. But the Fed really operates more at the short end of the yield curve. They're definitely going to raise interest rates in December. But more importantly is what they say at the time. I think they're going to signal a whole trend of raising interest rates. That makes the U.S. a magnet for capital. Capital from around the world wants to come to the United States. They're very encouraged by at least the initial read on President-elect Trump's economic programs. He wants to spend money on infrastructure, defense, wants less regulation, cuts taxes. Well, that all makes the U.S. an attractive destination. So combination of higher interest rates and Trump's plan, again, is bringing in capital from around the world. That's really why the dollar is so strong.
Yeah.
But that should continue.
And Treasury yields are not going up that much faster than other yields in developed economies. So is it really, Treasury yields supporting the dollar or something else really happening?
I think it's really the idea that capital wants to come to the United States, because your capital, you can go anywhere in the world. So you can be in emerging markets, you can be in other developed economies like Australia or Japan, you can be in the United States. Right now, the U.S. is showing, just a big green light or welcome sign. If you have lower taxes, less regulation, more government spending, more stimulus, and higher interest rates, that's nirvana for investors. I just got back from Ireland the other night, came back a couple of days ago, and they're sort of in a panic because, they have all this capital with 12% interest rates. A 12% corporate tax rate. U.S. corporate tax rate is 35%. But if you lower that to 15, which is what Trump is talking about, then a lot of the capital is going to leave Ireland, come back to the United States. Bad for them, good for us. So that's what's going on. But the flip side of the coin, Amir, and this is important, is that this money is coming out of emerging markets. So you're saying emerging markets currencies decline, emerging markets stock markets decline. That's a problem for them because they have $9 trillion in dollar-denominated corporate debt, not sovereign debt, but corporate debt. How are they going to pay that debt in a world where the dollar is stronger? That makes the real value of the debt go up, and capital is flowing out instead of flowing in. So this sounds like good short-term news for the U.S. economy, but this could trigger an emerging markets corporate debt crisis, maybe even worse than the 1980s during the Latin American debt crisis.
Yeah, and when you look at the markets more generally, when you look at the stocks, bonds, the dollar, how much of it is as you said, a scenario in which markets are front-running the Fed or investors are front-running the Fed, and how much of it do you really think has to do with the election?
Well, right now it's both. As I say, you've got even if the election had gone differently, even if Hillary Clinton had won, the Fed was still going to raise interest rates in December. So that was already on the table. We saw that reaction kind of even in early October when the price of gold went down the first time. Then it came back up and went back down again. So that's already on the table. But I think the election is the new factor. Now, the question, short-term question is, has it gone too far? But the longer-term question is, what are the implications of this? And the big one, of course, is that, if you cut taxes and increase spending and have larger deficits, and the Fed accommodates it, that's going to be very inflationary. So I would expect the price of gold to go up a lot next year as this inflationary vector kicks in. But here's the big question. Will the Fed accommodate larger deficits? Donald Trump is the helicopter money president. He's going to spend more, cut taxes, have larger deficits. The Fed can accommodate those deficits, which is really what helicopter money is. It's when you combine fiscal policy and monetary policy to create ease. That is definitely inflationary. But if the Fed leans against the inflation, raises interest rates more, that could throw the U.S. into a recession. So the way I'm constructing portfolios right now is to be prepared for both inflation and deflation, has some hedges and a lot of cash in the middle. I call it the barbell.
Why do you think Wall Street is so bullish on Trump if, as you said, he's going to be the deficit president? He has all these spending plans. At the same time, he wants to bring taxes down. The debt is supposed to increase under him. So why is the Wall Street, ticking up?
Well, of course, Wall Street has two parts, stocks and bonds. So stocks love it. Look, if you're a pharmaceutical company, you love less regulation. If you're a defense contractor, you love more defense spending. If you're a bank, you love less regulation and a steeper yield curve. If you're Caterpillar or John Deere, you love the fact that people are going to buy your equipment to build roads and bridges and so forth. So those are all the reasons the stock market is going up. But at the same time, as you described, Amir, the bond market is going down because the bond investors are saying, wait a second, this is all inflationary. By the way, inflation can give stocks a pop in the short run. In the longer run, inflation is very bad for the stock market because it destroys capital formation. But that's kind of a second-order effect that might play out a year and a half from now. But for now, you know, stocks are having a good run. But one of the points I make in my new book, Amir, The Road to Ruin, is that there are things that are bigger than Democrats versus Republicans or liberals versus conservatives. The systemic risk that's in the system, and it's getting worse by the day, could potentially cause a global financial panic worse than 2008. That could derail Trump's plans in a hurry. And again, it's bigger than Democrat versus Republican. This kind of global systemic risk is a big problem.
Yeah, and you were just talking about these sectors that are seeing a huge bump. You have defense, you have pharmaceutical, you've got commodities like copper doing well. I mean, does any part of you question whether this is all premature? I mean, after all, we have no material news whatsoever regarding the Trump administration's plans. Everything is very speculative at this point.
That's right. One of the reasons I think it's maybe not quite so speculative, but it could be very bad in the longer run, which is when you look at Trump's economic team, we know some of the names. I mean, they're not in official positions yet, but, you know, David Malpass, Larry Kudlow, Art Laffer, Steve Moore, these are the same people who orchestrated the Reagan Revolution in 1980, or sorry, 1981 when Ronald Reagan was sworn in. They're back. They're going to run the Reagan playbook. Remember, Reagan had large deficits. Reagan spent more on defense. You know, Star Wars, that's how, you know, the Strategic Defense Initiative, that's how he really broke the Russians and so forth. So that's what happened in 1980. But there are big differences today. It looks like Trump's going to run the Reagan playbook in a very different environment. Reagan had a 35% debt to GDP ratio when he started, rounded up to 50%. Trump is beginning with a 100% debt to GDP ratio. Reagan had 20% interest rates when he was sworn in. They had nowhere to go but down. Trump has close to zero interest rates. They have nowhere to go but up. So Reagan had a lot of tailwinds in terms of high interest rates that were coming down, high inflation that was coming down, disinflation was good for growth, and low debt to GDP. So he had fiscal space, the ability to increase the deficit. Trump has the opposite. Trump has interest rates that have nowhere to go but up. He's got inflation so low, it could probably only go up. And then he's got a very high debt to GDP ratio. He's going to spook the markets if he has more debt on top of that. So the way I describe it, you know, Reagan ran his playbook against a high school football team, not much resistance. Trump's going to run the same Reagan playbook against the New England Patriots. That could be a very different outcome.